Hey everyone, welcome back to Corporate Decoder, the place where we decode the confusing language of big business so you don't have to. You know, Chesapeake Utilities, they filed their quarterly report again, and let me tell you, it's an interesting read, packed with numbers that tell a story. We're talking about growth, energy, and all the financial gymnastics that power a utility company. Alright, so let's dive right into the numbers for the second quarter of 2025. Chesapeake Utilities brought in a cool $92.8 million in total operating revenues. That's a nice jump from $166.3 million in the same period last year. So that's good news. Across 6 months, they've pulled in $412 million for our business. Now, the money that actually stays with the company, their net income. For the 3 months ending June 30th, 2025, it's $23.9 million. Last year, for the same period, it was $18.2 million. That's a solid increase, and for the first half of the year, they posted $74.8 million compared to $64.4 million last year. That's a pretty healthy boost to their bottom line. They also like to talk about something called adjusted gross margin. For the second quarter, it's $142.8 million this year, up from $126.6 million last year. For the first 6 months, it hits $32.25.2 million, a good increase from $21.1 million in the prior year. This measure is important because it helps show how well their core energy delivery business is performing before some other expenses are factored in. Looking at operating income, which is revenue minus operating expenses, they managed $50.3 million for the quarter compared to $40.8 million last year. That's a strong improvement. For the first half of the year, operating income is $120.4 million in the previous year. This overall growth in operating income signals that the company is effectively managing its expenses while its revenues are climbing. Digging a bit deeper, we see growth in specific areas. For example, their Delaware natural gas division is doing well, with revenues climbing from $13.4 million in the first quarter of last year to $15.5 million this year. And in Florida, their natural gas distribution operations are also seeing a healthy boost, jumping from $40 million in revenue last year to almost $46.6 million this year. Beyond just traditional energy delivery, Chesapeake Utilities is also increasing its business in newer areas like CNG, RNG, and LNG services. They explicitly mention that these services are contributing to higher adjusted gross margins, which is a good sign they are adapting to the changing energy landscape. Now, not everything is a straight upward climb. We see that depreciation, amortization, and property tax costs have gone up. For the second quarter, these costs rose by $2.7 million. Over 6 months, it's a jump of $7.6 million. This makes sense. As the company invests more in new projects and equipment, it naturally leads to higher depreciation expenses. They also saw an increase in payroll benefits and other employee-related expenses. This went up by $1.7 million in the second quarter compared to last year, showing the cost of running their growing operations. It's important to note they still deal with costs related to that FCG acquisition. They had $1.4 million last year, and this year it's down to $0.5 million in the second quarter, and $2.3 million last year versus melts this year. These are ongoing integration costs that are gradually decreasing, which is a positive sign. Let's talk about where the money is going. Capital expenditures for the 6 months ended June 30, 2025 were $225 million. This is a significant investment aimed at building out their infrastructure and expanding their services. They've even updated their forecast for 2025, expecting capital expenditures to be between $375 million. This shows they are actively investing in future growth opportunities, especially in natural gas transmission and distribution. Their capital structure, or how they fund their business, looks pretty balanced. As of June 30, 2025, about 55% of their capitalization is from stockholders' equity, and 45% is from long-term debt. This is a healthy mix, leaning more towards equity, which generally signals financial stability. Overall, Chesapeake Utilities seems to be executing its strategy. They are growing their regulated energy business through rate case activities, infrastructure programs, and customer growth. They are also expanding their unregulated energy segment, driven by demand for newer services like CNG, RNG, and LNG. So what's my take? Well, Chesapeake Utilities is showing consistent growth in its key financial metrics. Their strategy of balancing stable, regulated earnings with investments in growth areas like renewable energy seems to be paying off. A notable strength is their proactive approach to regulatory matters, ensuring they can recover investments and earn a fair return for their shareholders. The significant capital expenditure plans indicate a strong commitment to expanding their services and capturing market opportunities. However, like any company in the energy sector, they are exposed to market price fluctuations and regulatory changes. The increase in operating expenses, while expected with growth, will need to be carefully managed to maintain profitability. The steady increase in customer numbers across their service territories is a clear sign of healthy demand and market penetration. In conclusion, looking at the financials and the company's strategic initiatives, Chesapeake Utilities appears to be on a solid growth trajectory. They are making smart investments and adapting to market trends, I'd say. They are well positioned for continued success. What's your opinion on Chesapeake Utilities' financial performance and their strategy for the future? Let me know in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe for more in-depth analysis of corporate filings. You can also join our Discord community in the description to keep the conversation going. Thanks for watching. See you next time.